All right. Good morning, everyone, and thank you so much for being here with us today. We're really excited for the program to kick off here. I'm going to keep my opening comments very brief as we begin, but just thank you for making the time. We're very excited about this program and grateful for the Federal Reserve team for making it happen. For those of you that I haven't had the chance to meet, my name is Dustin Taylor, and I proudly serve as the Executive Director with the Florida Institute of CFOs, CFO Exchange Group, and Chief People Group. On behalf of our 450 members around the state of Florida, we'd like to extend our sincere thank you to Dr. Bostic and his team for joining us at such a pivotal time in our economy. It's truly an honor to introduce today's distinguished speakers. Dr. Bostic is the president and CEO of the Federal Reserve Bank of Atlanta and serves on the Federal Open Market Committee, where he votes every third year. Before moving to the South in 2017, he was a professor at the University of Southern California, an assistant secretary at the U.S. Department of Housing and Urban Development, and an economist at the Federal Reserve Board of Governors. Raphael, I hope I kept that short enough there for you. On to Ira Burns. I'm pleased to also introduce today's moderator, Ira Burns, CFO and newly appointed president of World Connect Corporation, a Fortune 100 global energy management company headquartered in Miami, Florida. In his dual role, Ira oversees all aspects of the company's financial operations, and now an even greater role in shaping its global strategy. Ira is a longtime friend and advisory board member here with the Florida Institute of CFOs. Today's program consists of about 35 minutes of prepared remarks, followed by some interactive polling and Q&A. We're really excited for this program, and President Bostic, I think you'll be happy and hope it brings you a smile that today's session actually marks the largest virtual attendance that we've ever had. It even surpasses when we had the CFO of the NFL on. So you're a very popular man, and we're excited to dive into today's program. Ira and Raphael, I'll turn it over to you.
Well, thanks, Dustin. I'll start off. Raphael, thanks so much for joining all of us, and I see all the faces showing up on the screen. Thanks, everyone, for joining as well. So I'm going to jump right into questions, but before I do, I was going to mention that I'm actually in London today, where I'm sure you may be aware that shortly before this call, the Bank of England reduced interest rates from 4.25% to 4%. So I just thought, Raphael, I'd just casually bring that up. No pressure at all. I just wanted to make sure you heard that from me. So now we'll jump into some of the questions we've had prepared for you for today. So I know at my company, at World Connect, we're seeing a lot of uncertainty in the markets we serve, whether it's for us, aviation, marine, or ground-based transportation markets. And this seems to be true across a broad swath of the economy at the moment. In this kind of environment, how do you and your team go about building a coherent macroeconomic outlook? And what's your short and medium-term view today?
Well, Ira, first, let me just start by saying it's really good to be here, and I'm excited to talk with you today. And you made this happen, and you're on the other side of the pond. That's quite impressive. And to Dustin and his team, I just want to thank you all for all that you've done to make this happen. These things don't happen on their own. When I was at USC as a professor, I did a lot of events, and even though I was standing on stage, all the work was done by other people. And so just want to thank everyone who's been a part of this to help make this possible. Now, Ira, you mentioned uncertainty. That has been perhaps the most frequently used word that I've done in 2025. There has just been so many things that have gone on that have made it difficult to know exactly what's going to be next. And so one of the things that we've done in our team is really try to step back a bit and be open to the possibility or the reality that there are a ton of scenarios out there that could play out. And as rapidly as things are evolving and changing, it's very difficult to assign probabilities to any of them. So you just have to be open to scenarios. You have to be ready to adapt and adjust quickly. And I think there's a fair amount of effort that we've been doing on two fronts. One is just to try to figure out, is there a way to know what's more permanent versus things that are going to be fluid and continue to be fluid? And then the second is to really stay focused on who we are, which is we are monitors of the economy. We want to make sure we're understanding how all the key players are responding to the uncertainty. And that's been a key focus for us. So we've actually redoubled our efforts. We go out and talk to lots more people. We ask more focused questions about how are you doing? Where do you feel confident about your strategy? are you making a 3-month strategy? So, several months ago, a bunch of the big companies said, we're not even going to give you a year ahead projection because there's just too much churn going on. We need to understand all those things because that really sets us up really to have a sense about what the trajectory of the economy is going to be. Now, you asked about outlooks. My outlook right now is for the economy to continue its pace of slowing down. It's been slowing down for some time. But I also expect there to be some real uncertainty about what that means for labor markets, as well as what we're going to look at for inflation. So on the labor side, we've been asking folks for a long time what they're expecting to do. And what they've told us is, we're in a wait and see pattern. We're not going to hire more people. We're not looking to hire a ton of more people. We're not looking to lay people off either until we have a better sense of the landscape that's under our feet. On the inflation side, I do think that there is likely to be upward pressure on prices in the next 6 to 12 months. A lot of this has to do with the trade policy changes that are going on, but that puts real pressure on us. So one of the things we're trying to do, and one of the things I always try to do is be true to the Fed's dual mandate and really ask ourselves, and I ask myself and our team, how are we doing relative to the inflation side of the mandate? How are we doing relative to the employment side of the mandate? And then tease out from the answers to those two questions, what should we be doing with policy?
Great, thanks. As you answered that question so well, there's probably going to be a bit of overlap that I'll try to avoid because you covered a few topics there. It is interesting, Raphael, that you mentioned the word uncertainty. As I was preparing for today, I asked ChatGPT to give me some other words because I found myself using that word over and over again. Because obviously,
send me that list when you get a chance.
I was
love to
saying
do that. Love to have that.
Get off the call. So, moving over to a tariff-related question, surprise, surprise. Many of us on the call are obviously having heightened levels of concerns in different ways about tariffs, and I imagine you're getting related questions constantly these days. One thing we're really trying to understand is whether the impact could be more of a one-time bump in prices or something longer lasting. So how are you and your team thinking that through? And again, this may be a bit of overlap, especially when it comes to the longer term inflation outlook.
Well, this question about whether tariffs are a one-time thing or whether they're going to be more persistent in their effects and might even cause structural changes, I think is perhaps the most important question that we have today. If you think about econ textbooks, if you were in your econ 101 class, the idea of a tariff is that it's a one-time shift, and then everybody goes back to doing all the things they were doing before. So there are no real effects. And importantly, that shift happens pretty instantaneously. So you kind of know exactly what the change is, you know what the magnitude is, and there haven't been real changes in anything else that's going on in the economy. In that context, you would expect that to be really a temporary thing, short run, one-time hit, nobody takes it on board very seriously. And then in that case, you shouldn't expect policymakers to want to have to respond much to it because you're going to be back where you were right before the tariffs anyway. The question that I've been asking our team, and I've been asking myself really, is does that textbook model fit today's environment? And I think there are reasons that are pretty compelling that suggest that we should be somewhat skeptical about that. The first is just in terms of the speed at which the tariffs are being implemented. This has not been a one-time thing where you wake up on one day and everybody knows what all the tariffs are. In fact, they changed and the regime has changed pretty continuously. I think we just heard about some new ones proposed just yesterday in a whole host of areas that we didn't really have on the radar screen. And so in that context, it's unclear really how you would shift that curve because the things are changing all the time. And so that's one thing. The second piece is really about how long this is going on. You're seeing, say, you take India, for example, that number has bounced around 3 or 4 times over the last 4 or 5 months. And so if you have business in India, it is hard to know, upfront, what the tariff cost is going to be to you. And as a consequence, it's going to be difficult to build a strategy that you're going to have confidence that will endure over any length of time. And so those sorts of things suggest that the episode will last a lot longer than I think you would definitely see in it. It's definitely longer than you'd see in a textbook, but much longer, I think, than many people might have anticipated at the beginning of these changes, we're talking to a lot of businesses right now, and we've been asking them sort of, how are you thinking about this? How are you making decisions? A couple things have come out pretty clearly. One is that everyone is reticent to change prices on a rolling basis. They want their changes to happen once, maybe twice, and then be done with it, because consumers will not respond to a continuously evolving environment. And so that has caused a lot of businesses just to pause and say, I'm not going to do anything until I know exactly what's going on, where we stand in terms of our cost basis. So that's one thing. A second thing is that we're starting to see divergence across some businesses in terms of how they're thinking about this, in the sense of there's still uncertainty about where consumers are and how much consumers can take on board in terms of elevated costs. And so we're seeing a mix of strategies. Some are saying, I can't wait anymore, I got to go. Some are saying, I can wait a long time, so I'm just going to wait. Others are somewhere in between, and they're trying to tease some things out. All of this has really created some challenges. I do think the other thing I worry about is that the more that you have tariffs always on people's minds, the more it just becomes part of people's reality. And that higher cost can be something that then leads to expectations about where costs will be 3 months from now, 6 months from now, 12 months from now, to be much higher. You know, I think I'm always reminded about previous Fed Chair Alan Greenspan, when he said, you know, you're winning the battle against inflation when no one is thinking about it. Well, this is kind of the flip side of that. You know, it's on the front page every day. And so people are thinking about this in ways, and I worry about what that means for how consumers and businesses will approach their strategies for engaging in the marketplace moving forward. We still have a lot to learn. So I want to say nothing is settled, but these are the types of things that we're definitely paying close attention to. And as we learn, we will inject that into my views on policy.
Great, that was very helpful. Yeah, India yesterday was another part of the roller coaster ride, right? Sticking on the tariff topic for another moment. So we're now just starting to see the early signs of tariffs showing up in the June inflation data. What do you think explains the lag, and should we expect those effects to accelerate in the upcoming months, or may it taper off?
So, it's been very, very interesting, the range of views about how quickly tariffs should diffuse into the marketplace. I've seen reports by some who suggest that we've seen all we're going to see. There's nothing more that's going to happen. All the decisions have been made, so we don't have to worry about it. That's not what I'm hearing from my business contacts. And I think more and more that we will still be seeing strategic adjustments into 2026 and probably well into 2026 as the landscape becomes clearer. I do think that for some businesses, there are questions about how long you can wait. And I've actually increasingly been talking to businesses who's like, okay, I kind of have some sense of the range of the possible. And one thing that's been quite interesting over the last 2 months, maybe 6 weeks or so, I've heard, and our team has heard just more and more, that most business leaders have taken the doomsday scenario off the table. That the worst of the worst, I don't think, is in people's minds about what can likely happen. And that, I think, has contributed to some improvement in people's willingness to take a few steps, try some things, and create some expectations about what strategies will look like. But we still don't know what these final tariffs are going to be for most businesses. And that means that everyone is remaining a bit cautious. So I think it's going to be a while yet. And I do think that we've yet to see all the things that will happen.
Yeah, I agree. I wonder if we'll ever have an end to.
Well, it's funny you asked that. I mean, a lot of folks are saying exactly that they think this is just a new reality, and that on a Thursday morning they could get an announcement that things are changing, and that you're just going to have to get used to that. It's a very different mindset, and I think it presents real challenges for leaders in basically every sector in the country.
I totally agree with that. So moving on, I could ask you a lot of questions about tariffs, but I want to cover as many topics as we can in the short time that we have. So I know that at my company, at World Connect, while many parts of our business are still performing quite well, we are nevertheless being extremely cautious about every single hire, every capital investment that we consider making. What are you hearing from other business leaders on this topic? How are they navigating the current uncertainty in the economy when it comes to thinking about hiring, making capital investments, et cetera?
So the forward-looking approach, I think, is very similar to what you just said, which is until folks know where the world is, what the rules of the game are, it's hard to, well, we've heard people are not very confident making big bets, doing big capital investments and making big changes in how they produce goods or where they source their products from. One of the things that we have really heard a lot is that in many regards, the underlying fundamentals, the foundations of the economy are still quite solid. So at the beginning of the year, most folks we talked to were very optimistic about the prospects for 2025 and 2026. And then the tariffs came in at levels higher than people expected. And I think it caused everyone to step back and say, okay, I had one mindset, one thing in mind, and now I have something totally different. And so let's think about what a strategy looks like in that context. For most businesses, what we've heard is that if you've had a product that was already going, you just kept doing it. And it's the new ones, the big ones that folks are being more hesitant and cautious about. With the doomsday scenario coming off for some, they're like, okay, we're going to run. But that is not a consensus view right now. And we'll just have to see how that moves forward. This is one of the reasons why my outlook for the economy is for it to continue to slow, because we're not seeing the robust engagement that one might have expected at the beginning of the year. And we'll just have to see if we get to a point where businesses feel sufficiently confident that they're willing to just move forward in a very robust way. I'm hopeful we'll get clear signs on that in the next couple of months.
Yeah, the real question, I guess, is what will create that? What will change that will create that sentiment where people will get more? What will have to happen for people to get that comfort level?
Well, that's a question. I'm going to steal that question from you. I mean, we ask it in a lot of different ways, but I mean, I think that is one of the real things. Like, what's going to cause folks to be willing to get off the sidelines and make some pretty significant bets to try to drive higher levels of growth?
Okay, let's see where we're going to go next. So we have over 200 executives on this call, a lot of CFOs, all from the state of Florida, representing companies of all different shapes and sizes across a wide range of industries as well. So as a follow-up to what we just talked about, are you seeing any meaningful differences across different sectors or company sizes in terms of how businesses are faring and how they may be thinking and anticipating being impacted by all the craziness around us today?
Yeah, we're starting to see a lot of different strategies and approaches taken. And a lot of it depends on the sector that you're in, the scale that you have, and what your competitors are facing. And so I'll talk about each of those. So in terms of the size, we're getting very clear signals that small businesses are feeling the stress and strain in pretty acute ways. Small businesses already don't have a lot of extra resources. They don't have diverse supply chains. Some research that we've done would suggest that most small businesses, the vast majority, have one supplier and for many of their inputs, and that supplier is often from China or Vietnam. That creates direct exposures in ways that a smaller company just doesn't have the ability, the capability to adjust to very quickly. And so we're starting to hear those stresses. Those are the types of businesses that I think are going to be least able to forbear. And at some point, they're going to have to move prices just to address and reflect the reality of their increased cost structure. And that's one thing. In terms of sector, as I think everyone on this call knows, different companies have very different exposures to international trade. And so if you're in a sector that has a lot of exposure to that trade, you're feeling the pressures more. And you're going to be more likely to have to change your pricing strategies at a higher level. So in the surveys that we do, we're we split it out by trade related, trade oriented, and not. And what we see is respondents saying, if you're in those sectors, you're increasing more. Your expectations of your price increases are more significant. Your expectations about growth are more muted. And so we've got that as well. And then the other thing that's been quite interesting is we have seen businesses be much more strategic about how they're operating based on what they understand their competitors to be. So we've done some research that shows through our survey, on some of our survey responses, that shows that if you have a business model that is exposed to trade and the tariffs, but you're in a sector where most businesses do not, you're much less likely to respond with price in the marketplace. By contrast, if you flip this around, and if you're in a sector that's exposed to tariffs and trade, but your business model is not, you respond as if you're in that tariff regime. And so we're starting to see these kind of other kinds of effects, which makes sort of broad level macroeconomic forecasting even more complicated, because now you've got all these crosses and things that are going on that are quite challenging. I feel fortunate we had a great team doing great work to try to make sure that I'm aware of all of the different dynamics that are going on. But this spillover thing, the impact of tariffs on businesses that are not covered by tariffs, is something quite interesting. And I think if you look at, say, U.S. steel prices, they're up relative to where they were. And even though U.S. companies are not affected by the tariffs, because the competitors are. This is a classic type of scenario. And it's another reason why I think that we have still yet to see all the price changes that we're going to see and all the upward pressure on pricing.
Yeah, it's the roller coaster continues. So a good segue is jump into consumers. So it's pretty well established that inflation tends to hit lower and moderate income households the hardest. You just mentioned smaller businesses being impacted the most. Yep. Are you seeing signs that these households are feeling or reacting to current economic uncertainty more acutely than others? So while we're all business executives on this call, we're also consumers. Our families are consumers. Our friends are consumers. So we're looking at this from multiple angles. So whatever you could share there would be appreciated.
For sure. I'm a consumer too. So I go to the grocery store, I get my eggs and everybody, like everybody else. The prices are there and you just see it. Here's what I would say. We've been doing framework reviews for our long-run monetary policy statement for many years now. One of the things that we've done is we have a seminar series called Fed Listens. And in that series, we routinely ask, if it's a choice between high inflation or a weaker labor market, everyone says get rid of the high inflation. And so inflation is something that is on everyone's mind. It is incredibly painful. It is real-time jarring. So when you are in the store a week later and the prices are different, you notice that stays in your head and it has a real impact on folks. That is certainly true for lower income consumers. And what we've seen for them is the stresses for lower income consumers have been building from the sort of the height of the pandemic, when we had all those supports, the $1,400 check and all those sort of things. For those families, that extra money has been spent, right? So they are very much in stress, and we're starting to see all manner of strategies that they're using to try to stretch their money, going from label goods to the generics in stores, using dishwashing liquid or dishwasher liquid, or in the washing machine, using liquid or powder instead of the pods, because you can ration those things. And we're starting to see all of those choices being made. I don't know that it's gotten harder for them in the sense that once you start in that space, you're in that space. But we are definitely seeing stresses. I think the larger question, though, is how does the consumer more broadly and more generally respond if they start to see higher prices? Because when we had the first episode of elevated inflation, consumers had not really seen that for quite some time, and they had very strong balance sheets. Now we're having potentially a second period where prices are going to go up at a high level, but we've already just been through one where a lot of balance sheets have been weakened a bit. And so we don't know sort of where folks are going to, how they're going to respond, or where they will turn to buy their products and goods. And that will be one of the things that we'll really have to try to resolve as we look forward to how the economy moves and how businesses respond and react.
By the way, when you're the consumer and going to the grocery store and you're having a hard time getting a good deal on eggs, just let me know, because I have a farm in South Florida, so I could.
We should have been talking 2 weeks ago when I had my family visiting.
Oh, you go. Call me anytime. So last week's labor report seemed to surprise just about everyone, and well, as we know, upset a few people as well. What's your read on what's actually happening in the labor market right now, and how do you see it evolving over the next 12 to 18 months?
Well, I was on TV last week, just like an hour after those things came out, and it was a surprise to everyone. It's definitely something that everyone was speaking to. I think for me, the biggest eye-opening aspect of that data report were the revisions for the previous 2 months. Like I kind of expected things to slow down. Those revisions were quite large, and I think it really reflects some of the churn and the turbulence in the economy. That's just very hard to get a clear signal on this. I'll say the other thing I'll say is my district, I think the Southeast has actually been perhaps stronger than other parts of the country. And so as we've been going around, we've not been getting signs of the slowdown being that dramatic. And so one of the things that we will be looking to is in the next several weeks is to try to unpack this and really understand what this means. How should we be thinking about the next set of revisions on the numbers? And also really test with you leaders in business about what you're seeing and whether the numbers that came out over the last 3 months match what your experience is, or whether it's something actually quite different. That'll be an important thing. For me, I think it really did cause me to think a little differently about how well we're doing relative to our maximum employment mandate. Now, I said at the very beginning, we have two mandates. Inflation has been high. It's actually been, we haven't been at our 2% target for more than 4 years. That's a long time, and that's a problem. And for most of that time, the employment mandate has basically been at full employment, as good as you would hope it to be. The BLS numbers last week really raised the question as to whether we're still at full employment or whether we're moving away from it in a way that should mean that those risks, the risks to our two mandates, are much more in balance, as opposed to it being inflation is a big risk and employment is not right now. And that's the thing that that me and my team will really be having, I'll call them discussions, they'll be more like arguments about in the next few weeks leading up to the meeting in September.
Not to be political in any way, but the revisions that that came through, does that trouble you in any way? I mean, what's your read on that? Is that a new trend? Is it a one-time thing, or how would you comment on that?
So I'll say a couple things. So one, when I was a professor, one of the last projects I started before I came on this job was to look at revisions and to understand how revisions evolve and whether revisions to data affect people's perceptions of the marketplace. So revisions in and of themselves are not a new thing. They're something that happens all the time, and it's part of actually doing good statistical work to always be trying to refine. So the fact that there were revisions wasn't that troubling to me. The fact that they were large was surprising, but as we've been saying, ton of uncertainty today, lots of things that have happened that we've never seen in our lifetimes. So the idea that the standard approaches to collecting data might not capture all the things that are going on is not a huge surprise. And so I think one of the things that we should always be trying to do, though, is learn lessons from this and see if we can evolve our processes to be more on point. But that's very difficult to do in real time. And so I take my hat off to all the economists and the folks at the BLS who are doing their work on this. This is a really hard period. And I'm hopeful that the events that have happened and a lot of the commentary doesn't undermine people's confidence in what they're doing. They work super hard. I talk to a lot of them. I have the greatest respect for the work that they do. And it's really in all of our interests that they continue to do their work in a way that allows them to produce the highest quality, the most accurate data possible. And we will definitely support them in anything that they need.
I completely agree with you on that. Their job is a lot more difficult today, probably, than it ever has been. So financial markets, jumping to another topic, what's your read on the financial markets right now? It seems that up until now, markets have taken a lot of, I use the word again, on this uncertain stride, at least to some degree. Do you agree with that? And looking ahead, do you think that resilience continues, or is there something in your view that could start to crack the foundation more meaningfully?
So, I get lots of questions on this. And, the first thing I try to remind people is that the markets, financial markets are not our mandate. Our mandate is employment and stable prices. So I spend much more time focused on that. I will say it's been surprising to me how markets have been evolving. And in spite of a pretty significant shift in the cost basis for doing business, the markets seem to have sort of shrugged that off. I honestly ask others sort of why they think that is and what they're thinking, and how it should be interpreted. What I've been told is that the markets feel like they know the range of where these tariffs are going to land, and it's in a level or in a style that they can handle and that businesses can handle. But that's just speculation on all of our part. I think this is a good cocktail party conversation, to be honest, to try to discern sort of what the decisions, or how the decisions of millions of people all come together to make a statement. It's quite difficult. But I do think that in this environment, for me, I'm expecting that the volatility that we will see in pretty much everything is heightened. And so it would not surprise me to see swings in equity markets. I don't have any predictions on what'll trigger it or what that will look like. But because there's just so much that's unknown, so many data points that are coming in, it's really difficult to describe the psychology of a financial market. I'm a psych major. I was a psych major with econ. So I know people are super complicated. And then you bring them all together in the marketplace, the complicated gets even more complicated.
Yeah, the law of exponential complication, I suppose, right? And not to continue on that same path, but just a moment longer. In listening to everything you've said so far, earlier we talked about the fact that the smaller businesses are the ones that seem to be worried more. Larger players in the financial markets seem to have a different view because their egos are bigger and they're maybe more confident that the world's going to be a better place. Maybe there's more educational background. They lived through it many times. So there's a bit of a dichotomy, right? Because it seems like big business is kind of okay. Small business is getting more worried every day.
Well, I think big businesses just have more buffer resources, right? So if things happen, they have the ability to shift workforces in bigger ways. They have a bigger capital stack that they can tap into. They actually have more relationships out there that they can then use to get information and then respond quickly. So I do think they have some structural advantages which allow them to weather things more readily. The question, though, is being able to parry and manage is different than really being able to just avoid and totally absorb. And so we'll just have to see how that plays out. I actually wanted to say one other thing on tariffs while I'm thinking about it, which is the other thing about these tariffs, which I think is actually quite interesting, and I think we all need to reflect on, is the fact that these tariffs are actually designed to change people's and businesses' supply chains. They're designed to actually lead to structural, enduring changes in how businesses operate. And if that is the case, then I don't think that these tariffs are likely to be something that you should look through, because they're inducing structural changes. And if there are structural changes that happen, then you would expect there to be structural changes or fundamental changes in the dynamics of inflation and employment and all those other things. So I think one other question that we all need to have in mind is, to what extent do we think that these tariffs are likely to succeed in driving that structural change? Because if that does, then it means the impacts are going to be far more permanent.
Great point. I've got a couple more before we go to the poll and some questions from everyone on the call. So I won't ask you to directly comment on the new federal fiscal package, or as it's been called, one big beautiful bill, though as always, beauty is in the eye of the beholder, or maybe in this case, it's the debt holder, my attempt at financial humor. With that said, with the debt ceiling being increased as part of it, how, if at all, does that affect the Fed's balance sheet or your approach to balance sheet management going forward?
Well, balance sheet management is really about trying to make sure there's a lot of liquidity so that markets function. And, the debt will divert resources out of liquidity, some liquidity segments to others, and really to try to fund and finance that debt. And so we'll have to watch what's happening in that space. We've been over the last several years reducing the size of our balance sheet, trying to move it out of an emergency posture into one that's sort of more ordinary and sustained. And we've made tremendous progress on that. And I think, I've been in many settings where people had doubts that we would do it. And I've been really pleased about the amount of progress that we've made on that. So we'll have to think about that. So we're going to watch, and we've not ever seen a period where the U.S. central bank has tried to reduce its balance sheet so dramatically. And so we're getting to a territory where where you may be at a point where we reduce it beyond the point that markets can function, and from a liquidity perspective. And so we're watching that very carefully. We've developed some new metrics to try to assess how much liquidity is in the marketplace. And we'll just be watching over the next several months as the Treasury issuances play out to see how reserves evolve, and to try to get a sense of how much liquidity there is. But again, I think people should not think that any adjustments that we make reflect a lack of certainty or commitment to getting us back to a more normal posture with our balance sheet. That's essential. We need the U.S. economy to stand on its own, and us move into the background just to make sure that things function.
Great, thanks for that as well. So my last question. So I know you share your latest thoughts on rates last Friday, and for the audience, you said, with new information, it's appropriate to rethink everything, and that's what I will be doing with my team. So that's what you said last Friday. Any early updates on such rethinking 6 days later that you may want to share? I had a question that everyone was dying to hear an answer to.
Oh,
so
no. So no, I'm fully
Friday.
expecting that. So here's what I'd say. I've been for most of this year on one cut for the year. Today, I'm still on that. I fortunately have 5 weeks, I think 5 or 6 weeks before the next meeting. We're actually going to get a lot of data around inflation, around what's happening in terms of employment, that will allow me to think about how to the relative balance of risks between inflation and employment. The employment number did say that the risk in employment side is much higher than it had been in my mind going into the meeting last week. And so I will definitely be looking carefully on that. And actually listening to a lot of folks, a lot of business leaders, a lot of my colleagues around what they're seeing, so that we collectively have the right view about where the economy is, how it's functioning, so that we can get to a policy that makes the most sense for where we are today.
Next year? Any comments on next year?
In terms of our policy posture? So I'm hopeful that we get through the elevated pricing pressures in an orderly and a quick way, so that we can actually start to return our policy rate to neutral. I think my outlook today is that we're going to get there next year, probably to the middle, to the later part of it. But there's so much moving. There are so many moving parts that it's hard to have a lot of confidence on that. I've actually started asking folks when I give in-person talks, like, how many of you had a plan at the beginning of the year? Is it the same plan that you have today? Do you think it'll be the same plan that you have 3 months from now? And no hands go up on the last one. It's become very, very difficult to forecast. So I'm just going to keep my eyes open, keep my head down, and try to make sure that I notice the turns and trends sufficiently fast that I can adapt my policy strategy for that.
Thanks. Really appreciate all of your candid answers. I think now we're going to jump to the polling questions, Dustin. Is that right?
Yeah, that's right, Ira. Thank you guys so much for that. President Bostic, I also wanted to give you the opportunity to share a little bit more information about your CFO survey and the data collection process at the Fed.
Well, sure. I mentioned a lot today about how we talk to lots of folks. We try to get a lot of information from people. We do this, we have a bunch of people who do one-on-one conversations, but we've actually built up a pretty significant survey center here. And one of the surveys that we run is a survey of CFOs. We do this in concert with the Richmond Fed and folks at Duke University. And we just call survey, we try to get CFOs to give us pictures about what they're seeing. So if you want to participate in the survey, if you want to be a respondent, you have the QR code there. Please do click on that. Let us know. We're always looking to fill in our respondent base so that we cover all the sectors, all sizes, all industries. It is a national survey. So Florida is super important for us. So I really encourage you to do that and become part of the way that we learn about what's happening in the economy so that we make better policy moving forward.
Excellent. Thank you, Raphael. And I'm actually now going to turn it over to Ann, our managing director, to deploy some live audience polls.
All right. Good morning, everyone. And so you should see some polls showing up on your screen here. This adds a little bit of interactivity to this virtual program, but also for our members who want to receive CPE through NASBA, or for our HR professionals that want to receive PDCs through SHRM, these polling questions are required. So please scroll down. There's 4 questions you should see on our screen. I'm gonna read through the options because we do have people that are joining over the phone. So question 1, over the next 12 months, how do you expect your domestic employee headcount to change? And we have options that go all the way from increasing from 0, 5%, 10%, more than that, no change, or decreasing by less than 5%, 5 to 10, or more than 10%. Question 2 is, how have economic and policy uncertainties affected your investment plans over the next 12 months? Respondent answers are they increasing? Are you maintaining? Are you delaying investments? Or are you scaling back any planned investments? Question number 3 is, how do you expect tariffs to improve pricing over the next 12 months? Are you expecting no impact, slight increase, moderate increase, significant increase, or are you expecting decreases? And finally, question number 4, over the last 90 days, what trends are you seeing in customer payment behavior? I know this is one that Dr. Bostic enjoys, that we've heard. So are you seeing that your customers are paying more quickly? They're doing prompt payments. Are you seeing predictable timing, so there's no real change? Or are you seeing there's prolonged terms or even delinquent payments coming through? And I'm going to go ahead and close the poll so we can get a quick little look at the results here. And so you should see the results on your screen now. But Ira, I know you wanted to take a look at this and go into maybe some immediate thoughts. Dustin, I'll bring you into the conversation as well. It definitely looks like with the first question of domestic employee headcount, in total, about 50% of respondents either said no change or less than a 5% change. So that's pretty small. I'll hand it back over so you guys can go through the
certainly positive, Raphael. I assume you could see the results on your screen.
So I'm not actually seeing them very well. They're kind of at distance. So if you could just summarize them, that would be great.
Absolutely.
Yeah. You want me?
Go ahead, Ira.
Yeah. So the way I group it, I would say 50% of the folks that responded said no change to increase of less than 5%, and decreases by anywhere from 0 to 10% were only 24% of the group, and then there was a small part of the group, actually it was pretty impressive, that said their headcount they're looking to increase their headcount by greater than 10%. That was 8%. But half of the group is arguably stable to positive, and then 25% assumed a decline. Most of that 25% was less than 5%.
Yeah, so that's actually very consistent with what we've been hearing. Slight upward bias in the hiring expectations, but not gangbusters by any stretch. And because we know that there are some sectors such as housing and home building where they are really struggled. There are businesses that are reporting that they're having real difficulties. It's very consistent. I think the thing that will be interesting moving forward is how the percentages evolve. Do they stay at this 50-25 split, or do they move much more into like a 35-35 split? That would really signal something significant.
Great. The next question was on investment plans over the next 12 months. So 72%, well, 64 out of that 72 said maintain current. A small percentage said they plan on increasing their investment plans. And then about a third, a little less than a third, are looking to either delay or scale back.
And so this is also quite consistent. The holds is the play that we're hearing from everybody. And the scale back, it'd be interesting to know, are people seeing these as big projects, or are they just holding on everything? Such that some of the maintenance things are not going on as well. But this is actually quite consistent as well, that folks are not really projecting, and the respondents here are not projecting a huge amount of widespread distress, which I think is actually quite interesting and reflects a comfort with kind of the status quo and where we are.
It's because the state of Florida is so amazing. I think that's why these answers.
Exactly. And
on tariffs, again, the question is, how do you expect tariffs to impact pricing over the next 12 months? 43% answered a moderate 3 to 5% increase. Another 26% said slight increase of 1 to 2. So, 70% said they expect prices to increase, and then 16% suggested a significant increase, 6% or more. Only 14% responded no impact. So it was either the number one answer was moderate, and then there were two camps, some a little lower, some a little higher.
So that's actually very interesting. Our target is 2, right? So if it looks like almost 60% are 3 or more. So that's the upward pressure that we were talking about earlier. And I think the two questions that would follow on to this is, all right, if that's 12 months, where are you the next 12 months? Like, do you think this is something where you're going to continue at these elevated levels? And then the second is handicapping this. Like, you had to put a probability. So we've started doing this, say, okay, we're going to give you 3 scenarios, put a probability on the 3 of them to see. So what I think most people have done, what they think is most likely, but is the second most likely the 1%, or is it the 6%? Right. And those are the things that I think can provide some interesting nuance. These sort of things that we ask in our surveys, actually, to try to really understand the breadth of the pressure.
You and I have had dinner together with a group of CFOs a couple of times, and you always ask the following question, from what I remember, which is, have you seen trends in customer payment patterns? So remember, we had that.
I do.
And there was somebody there that isn't on this call that had a really scary answer at the time that both doubted. I don't know if you remember that session, but so today, 63% of the group said they're not seeing any changes, which is good. I know that was my answer. I was actually surprised to see that 30% said they're seeing either prolonged terms or slower payments or extended timelines. I don't know if that's consistent with what you've been seeing.
Well, I think it is consistent with the idea that stress is emerging and is real for a number of folks. If you think about the prolonged terms, we have been hearing that some subcontractors, some suppliers are asking for changes, like if in terms of repayment, because there's the churn on things. So that is not 100% surprise. I think 30% suggests that there is some migration in that right now, upward, which could be concerning and something that we'll definitely have to keep keep an eye on. The no change actually for me seems pretty on point in the sense that we've not seen in the aggregate numbers a lot of big moves in the pricing, right? Folks have been using forbearance strategies. Folks have been trying to find other ways to cut costs that don't show up in prices. So those things I think might mute the need to respond with different changes in terms. But what we've been hearing is for many businesses, they're kind of almost at the end of the line for how those forbearance strategies can play out. And so they'll have to make some other decisions moving forward. So this is another one I give for your group. You might do this poll like the next 3 or 4 times you guys get together, just to see how things evolve, because that is real information. You know, one thing I try to tell folks is in these type of settings and these environments, the decisions you're making are the economy. So talk to each other, pay attention to each other, because there is learning that happens when you start to see or hear trends from the people among you. You all are the leaders of business across the state and play an important role in how our economy evolves moving forward.
Dustin, when Raphael said that, I was going to say the same thing. So we do surveys regularly. We should definitely keep asking that question. And if that number changes, we should send the information to this gentleman.
Yeah, you need to call me right away. Call me right away. Exactly right.
Absolutely.
Okay, I have some questions from the group now, right, Dust?
Absolutely. So I'll jump in here just to field a couple of these. We've got about 10 minutes left, and I know one that comes up very frequently is around Fed independence. And David Comite asked the question around, does the current political environment affect how you make decisions, or are you able to remain independent?
So what I'd say this is, yes, I am. My job is really to try to make sure that the economy performs in ways that are consistent with full employment and maximum price stability. And that means that our horizon is different than the horizon of many others out in the world. And, you know, from the very first days of me in this job, I would turn on the TV and people would be griping about things that we were doing, complaining, having different views. And that's really just part of the territory. So for me, I really do just try to keep my head down, keep perspective, understand that central bankers are often in positions that are not the most popular, but are the right places to be for what our charge is. And that's kind of how I'm going to approach it. And you know, I talk to my colleagues on this. We are all in the same mindset. It's the job that we have. And that's what we're going to just keep doing.
Thank you very much for that. Another one from one of our board members in Tampa. The last FOMC meeting was the first dual dissenting votes in over 30 years. As business leaders, we are accustomed to occasional disagreements in the boardroom. Is this something you anticipate will continue in upcoming FOMC meetings?
So it would not surprise me in the sense that this is a really complicated time. And there are so many different scenarios that could play out. And a lot of what folks are doing, what I'm doing, is really trying to say, okay, which one do I think is most likely? Which one do I think is second most likely? How do I do probabilities? And to the extent that my colleagues put different weights on things, it will point to different policy prescriptions that make sense. And because there are so many moving parts, I think it's actually much harder now to do policy than it was 12 months ago, where inflation was really in a hard place. And we clearly need to do that. Now you're seeing a lot of churn. The risks to the mandates are moving and they're fluid. And so it doesn't surprise me that people wind up in different places. You know, the one thing I will say, though, is even with the dissents, it's a thoughtful conversation. It's an engaged conversation. I learn things from my colleagues, even when I land in a different place than they do. And I think for me, it's a sign that everyone should know that we are taking this seriously, and we are really sticking to our guns. We have a view about the world, and our job is to try to be as persuasive and compelling as possible. Because when you hear it that way, when I get to the end of the meeting, I kind of feel comfortable with where the committee ultimately winds up.
Absolutely. That's great. I know one topic that has continually been brought up across all of our executive communities is around AI. So I'd be curious to hear your thoughts and how the Federal Reserve is thinking about AI and its impacts on labor productivity, wages, potential job displacement across many sectors. Does the Fed see AI as a deflationary force?
All right, so I'm going to hold on the last part of that question, and just start with the first. You know, we've been asking about AI in our surveys for the better part of 3 or 4 years. And until about 4 months ago, what businesses were telling us was, yeah, we're dabbling in it. We have it in a sandbox over here. It's not really in our business processes. It's not really material to how we're doing things. In the last couple of months, that has changed. And I'm hearing much more from businesses, oh yeah, we figured this out. We have a couple things that we're going to do right now that we think are going to enhance the productivity of our workforce, and we're going to run hard on it. What businesses have been less explicit or clear on is the implications for the needed level of employment, and whether they will continue to deploy these in really intensive ways. So I'm not hearing as a general matter that folks are expecting they're going to lay off like 30% of their staff because they have some artificial intelligence. But we are hearing that folks do believe this productivity increase is going to be material, and it could reduce costs. Now, the other piece, and I'll just say for me, one of the things that is quite interesting about this technology is that it is disrupting, as you alluded to, parts of the economy that have not historically been disrupted by new technologies. Typically, the new technology disrupts the jobs that have the least specialized skill, like the stuff at the bottom that you can replicate. This technology is actually going to disrupt job categories for people that actually had to go through a lot of education, a lot of training, a lot of specialization. That's quite different than I think what we've seen. And it'll be interesting to see what the response to that is writ large as we think about having to retrain people to be positioned to be competitive for the jobs of tomorrow. I think it's a major challenge that we are going to face, and one that I think merits a lot more conversation than what's happening today.
That's great. The closing question I would have is another one of our board members in South Florida is Mark Kempa, the CFO of Norwegian Cruise Line. You may have seen the interview recently from PayPal's CEO, who highlighted the tremendous growth that they've seen in buy now, pay later usage among the younger consumers. How is the Fed evaluating the expansion of buy now, pay later and similar credit tools? And is it seen as a financial stability risk or more of a signal on consumer sentiment and liquidity?
All right, so I'm going to say I'm conservative and I'm cheap, right? So I don't like to do things where I don't think I can pay it back. And I do think that, the pay later for me, and this is just personal, right? That is one where you're taking a risk that you're going to have the money down the road. So to me, it's more a sign that folks are feeling more stretched, and that they're having to rely on strategies that may or may not play out moving forward in the future. And so that to me is a source of concern. Now, it may be everyone is able to pay it back, right? So I'm not making any judgment on sort of the outcome of the transaction, but that choice does say something about where families see their balance sheets in ways that suggest that we need to unpack this more, dive more into it, and really have a clear sense about the extent of discomfort or stress that people are having to do things. Yeah, it's just it's not something that I do, but there are a lot of things but the folks here will tell you I'm the last person to do every technology. It always breaks down for me. I'm happy to be late. So on that stuff. So I would just say this: the consumer is a big question mark right now, in the sense of we don't know how consumers are going to respond in the environment that we're in today, and it's something that everybody needs to be mindful of. And it goes back to what Ira and I were just saying. If you see big changes and things happening that are not close to what you expected, those are things that we really need to know in real time, because that will be real information that something is happening that we really need to do a deep dive in and understand.
That's great. And President Bostic, I want to close with another slide to share that you might share about the weekly digest that your organization provides as well.
Yeah, so I got a great team. We have a lot of tools, we have a lot of data things, we do a lot of papers, and we actually try to do them in ways that are accessible to regular people. So you don't need a PhD or any of that kind of stuff. And we do it for you, for the public. So please subscribe to us. We have a weekly digest that tells you the things that we think are interesting, and then you'll know all the things that we do, so that when next time you see me, when I talk. It won't be a surprise. It'll be, yep, that's exactly what I expected. So, so please do join our family. And I really do enjoy talking to you and doing these sorts of things all the time.
Excellent. Well, I know we talked about this earlier on the call before everyone joined, and I believe there's an FOMC meeting on these exact dates. But for everyone on the line, this is our 2026 CFO Summit that's taking place at the Breakers in Palm Beach. We're very excited to have everyone out for that event next year. And Bostic, if you can get the crew to move the FOMC meeting to the Breakers, we'd love to have you.
Well, I'll call Jay and see what he has to say about that.
There we go.
Call Jay and then have Jay call Darren, who's the CFO.
All right, there you go.
That's right. And lastly, coming up very soon, our CPG retreat in Orlando on September 11th and 12th. If you're in the state of Florida, there's a lot of CHROs on the line today, or if your CHRO wants to join a community with peers, please reach out. Thank you all very much for making the time to be here with us today. We are grateful for your attendance, and we're really grateful for the insights on behalf of the Federal Reserve. Thank you, Raphael.
Thanks again.
It's been a lot of fun.
A lot of fun.